Well, hello and welcome to Trading Blows, a very busy show in what is a very busy week for the financial markets this week. Plenty of central bank decisions for myself and the panel to get our teeth into, including those from the Fed, the ECB and the Bank of Japan. We'll also dig into some of the recent economic data releases, particularly those out of Europe, and whether they should give traders cause for concern. And we'll also have a bit of a dig into and a debate over what might drive markets over the rest of the summer as we look ahead to the month of August. Without further ado, let's get into the show. So, as always, plenty for us to discuss, and as always, the panel will score points for a great response. The better their response, the more points they will score, and of course they have the threat of points being chalked off looming over them if a dispute is raised over their answer. Joining me on the show this week for our last show before a little bit of summer break until September, Richard Matthews, a veteran of the city and someone who was in danger of being declared winner by default given the technical issues we were having a brief moment ago. Also with us is Arno Venter from down in South Africa, and Ioan Smith, an analyst who's a veteran of the sell side and his own research firm as well. With that said and done, let's get into the first round. Right, I want to kick things off with talking about the ECB. And actually, before I do that, I should probably clarify, we're recording this on Wednesday, probably about 6 hours before the Fed announced their decision. And of course, by the time you watch this, the Fed will have announced policy. So although we'll touch on their outlook, we're not going to get into it in too much depth, because unfortunately, none of us have been blessed with the gift of psychic powers or a crystal ball. What we can do, though, is preview the ECB, which is coming up on Thursday. It feels like a 25 basis point hike is locked in there. So I guess the real question, and Dick, we'll start with you. Should we really be discussing what the ECB going to do in July, or is the bigger question what they're going to do next month in September?
Isn't the biggest question how deep Christine Lagarde's tan's going to be? She must have been down on the beaches by now. I don't know what shade we're going to be looking for. Dark suede, I should imagine, and a nice herb scarf to offset it. I'm glad we started on the ECB, my second favourite central bank after the Bank of England. Yeah, I think that's probably right, actually. We should be looking forward a bit. I don't think we're going to get any guidance. I'm assuming that we're going to get 25 basis points from the Fed. Or we've had 25 basis points from the Fed before I talk, and that we're going to get 25 basis points from the ECB. I think that's pretty much nailed on. I suspect Madame Lagarde will get up. I don't think she'll give any forward guidance. I think she'll just waffle, which she is second only to me at being able to do. And as we all know, the Europe as a whole is very, very good at fudge. And I think they'll just come out with fudge and they won't commit to anything. I suspect they might start becoming a little bit more data dependent. They've been very optimistic up until about 2 or 3 weeks ago, and they've started sounding a little bit dovish now. Bank lending's obviously not brilliant. The figures came out yesterday and today. I could quote some numbers, but I haven't got my glasses on, so I can't read them. But actually, I can. Corporates is down from 2.1% in May to 1.7% in June. And households slowed from 4% to 3% in bank lending, which actually shows a contraction of the money supply, which obviously is good to control inflation. IFO in Germany wasn't brilliant. So I think that they will slow down. People still looking for a hike in September. I'm not sure that you'll get it. And I think that the meeting will probably be a non-event. Looking at volatility over the meeting, it's like something like 60 pips people are talking about against the dollar, which is a way lower than normal. So, in answer to your question, I think actually you're right. We should be looking for the next meeting in September, and just sit on the beach and put our feet up and see what comes out. I don't think that we can actually take too much or make too many decisions as yet.
Yeah, I think my own views are very much in line with yours, actually, Dick. And you mentioned that low implied vol going into the meeting. And actually, if you kind of look back, and I haven't got any historical data for this, it's just purely anecdotally, it does feel like the July meeting for the ECB has always been very much a case of get it out of the way, don't rock the boat. We all want to go away and enjoy our 4 or 5 week summer break on the beach somewhere. And I think that's probably the vibe that we're going to get again. Ewan, I'm keen to bring you into the conversation. I mean, as Dick alluded to, we had the bank lending survey a little bit earlier on in the week. Things are not looking particularly brilliant for Europe at the moment. I mean, you could even argue a little bit stagflationary. I know we're going to get onto the data in a later round, but how do you reckon the ECB will react to that sticky inflation, slowing growth combination?
Can I just interject?
Oh, it's like having Ryan on the show.
No. I'm not sitting on any cushion. I must have scored a point with that answer.
You did. You scored 8.
Does that show up on the scoreboard?
Oh dear, Kyriakos must have broken something again. We'll get him to fix it in the edit. Ewan, anyway, how are the ECB going to react to what is looking a bit stagflationary?
Well, I mean, like we've talked about, 25 is probably baked in this week. Then, I mean, we've talked about it on this show before about the velocity. I mean, we've gone from like 0 to 4.25% in a year, and we've talked about the velocity and how fast this will eventually impact. You know, especially loan demand going forward. I mean, Nott himself. I mean, he's obviously an arch hawk, and he's now suggesting that the underlying inflation's peaked. And I mean, this week's move's probably the last in the cycle. 3-month money rates are now well short of where they were back in March. So the market's starting to turn as well. So, and in fact, it's quite interesting that, especially in the options market in Euribor, they're now looking, or there's some volume going through for a cut in September, which is quite interesting. So this could actually be Trichet's, it could be Lagarde's Trichet's moment. But like Dick alluded to there, I mean, the interesting thing is the record drop in loan demand. I mean, obviously the velocity of the increase in rates has led to this. You're starting to see, borrowing for house purchases, falling. I mean, it's the lowest since August 2015 in France. I mean, and house prices across the Eurozone in general. I mean, they started to post outright declines for Q4 and Q1. I mean, this is the first quarter-on-quarter drop in over 8 years. So this is what the ECB have to respond to. We've had the German manufacturing PMI like sub 40. I mean, the only times that this has happened was the COVID and the GFC. So I mean, we're talking about the 4th biggest economy here. So while they want to just pack up and go away for the summer, I think there are a number of underlying issues that they're going to have to respond to pretty quickly when they come back in September.
Yes, and we know that Europe love to respond to underlying issues by coming up with, as Dick said, a fudge, kicking the can down the road, hoping everyone forgets about it and it goes away by itself. Arno, let's turn to the markets a little bit. I mean, as Ewan alluded to, it's very quickly, sentiment seems to have gone from ECB going to get to 4% to now, actually, they're going to get to 3.75, but how long are they going to stay there? Perhaps not very long. The euro has come off a little bit from the highs that we saw a couple of weeks ago, but we're still north of 110. I mean, which way do you think the balance of risks is for the euro, not just over the ECB on Thursday, but also a little bit over the medium term as well?
I think skewed lower from here, mate. We are currently short euro versus the dollar. We had a basket running, but we closed most of the baskets. Currently just running that versus the dollar from Friday, and obviously from Monday after the PMI data as well. I think the path is tilted lower for the single currency here. Look, everything has been. There's been many negatives that's been building up for the euro over the course of the last few months, right? I mean, deteriorating growth differentials has been a key focus for us. You know that even back in February, when everybody was still excited about, Eurozone growth going to the moon, or at least not collapsing. We've been saying that we just don't buy that. We don't see that, in the underlying data. So growth differentials points lower for the single currency right now. Yield differentials points lower, especially when you can compare it to the dollar. Like the guys mentioned already, credit standards or lending standards have been deteriorating. That isn't going to be a positive, especially in the months ahead. Even though Dick mentioned implied vol, and even though implied vol is relatively low, we have been grinding higher. So it does suggest that it is a little bit of a risk building up for the euro right now. Risk reversals are pointing lower. Literally, I think the only thing that's been keeping it up has been that very coherent hawkish language that we've heard from the ECB. They've been really trying to keep up that hawkish front for the past couple of months, and we're starting to see a little bit of cracks in that. Like Ewan mentioned, we had Klaas Knot coming out, sounding a little bit more dovish than what you would expect. Saying that suddenly starting to think about doing too much. That's not really something that you would expect the Hawks to say at this stage, especially if they are going to 4% or whatever. So I think the last domino that can fall would be the ECB turning dovish, and I think that'll be the last nail in the coffin for the euro to see a little bit of downside. So we are currently positioned for that. Even if we do see them trying to sound hawkish, I'm not sure whether the markets will really buy it at this stage based on the data that we've had. I think unless the Fed comes out incredibly dovish, which I don't think they will, I don't see a lot of scope for massive appreciation here for euro dollar. So I think the balance of risks is firmly tilted to the downside for you.
Yes, I think I would agree with that. And actually, just if you dig into what the market's pricing on rates, when I looked earlier on this morning, and again, this is before Jay Powell has spoken on Wednesday night, so this could change completely. But the market's pricing about a 60% chance, near as makes no difference, that the ECB hike in September. And the market's pricing just a 20% chance that the Fed deliver a second hike after one in July. And to me, and I'm sure you guys will agree with me, that feels like it's the wrong way around.
Yeah, absolutely. I would totally agree, especially if you just look at the data. The PMIs, they were dismal on Monday. It's across France, across Germany. We'll talk about the data in a second, but it's across manufacturing and services. So I completely agree, mate. I think it should be the other way around for those two.
Indeed. Well, before Arno delivers all of his sort of soliloquy for the third round now, let's get on to the BoJ before he does that. I don't think I said it right. I'm hoping Kyriakos can edit that out. Right, let's get on to something I can pronounce, which is the Bank of Japan. Nice and easy for anyone to say the BoJ. Obviously, rounding out what is an incredibly busy week for central banks in the early hours of Friday morning. There's been so many sources reports for the Bank of Japan meeting. I almost question, what's the point of actually having it? Because I think most of it's been kind of leaked to the media in advance. But Ewan, what are your thoughts going into the BoJ? Are we going to see any tweaks to yield curve control? Are we going to see this much rumoured upgrade to the inflation forecast? And I guess more importantly, is any of this actually going to matter?
I think you summed it up there, to be honest with you. I think it'll be a non-event. They'll unanimously vote to maintain its current stance. And they'll keep debating the costs and the benefits of yield curve control and the negative overnight rate. Ueda already said last week after the G20 that, unless the 2% inflation is achieved, then the overall story is going to stay unchanged. So there's no reason to expect anything different. I think the most interesting thing will be the outlook report. They're expected to increase their consumer inflation above 2% for the core. I think that's excluding the fresh food, but that would be for this year, and that they were at 1.8%. So, but people know this already. So, again, it's all priced in. Nothing much is going to happen. I think, going forward, I think it's their inflation projections for next year. So they'll be managing the market's expectations there. So I think, like where they'll talk about uncertainty about global growth and domestic wage hikes, but for next year, I think, or 2025, they're still only at 1.6%. So I'm not saying that they're going to, keep yield curve control and negative interest rates sort of throughout that whole time period, but that's where they are. That's where their thinking is. And I know people will point to, like wages are rising at their fastest rate in nearly 30 years or whatever. But I mean, it's still slower than prices, and it's still modest compared to, to other countries. So I think, if you're trading yen or something like that, I don't think you're going to get much in terms of a catalyst for the meeting itself. If you want to do anything over the summer, again, you just be reactive. And interestingly, I mean, you can chart the yen dollar against US Treasury yields, and you can get the correlation from there. So wherever yields go, the yen and dollar will probably go as well. I mean, especially the 5 years. So, yeah.
Yeah, absolutely. Arno, are you going to be up nice and early on Friday morning for the Bank of Japan meeting and all the potential excitement that it holds?
Absolutely not, mate. I mean, I'll read the after pieces, for that. When it comes to the BoJ, to Ewan's point, I was quite surprised by the market's very strong reaction to that sources piece that we had. The sources piece came out when, I think, Thursday or Friday last week. But to Ewan's point, we had Ueda talking on Tuesday, telling us the exact same thing, just, in a slightly more veiled way, if you will. So I didn't really see any real surprises out of that sources piece. Ueda told us they're not going to adjust policy. The markets didn't do anything. Then the sources piece drops and the yen, completely tanks on the back of that. So that was a little bit of a weird one. It shows us that there's a lot of speculators in the market right now. So obviously big surprises like that, which isn't surprises, when you see the markets react like that, there's going to be a few big players out there that has some real positions running on it. In terms of the meeting, look, I agree with you, and if inflation at the peak of, where were we at, 4.3%, if that wasn't a problem for them, why would inflation being a whole percentage point lower be a problem for them now? I just don't see that as a problem. Yes, wage growth is higher, and yes, inflation expectations have been ticking higher. But so far, the bank's communication has been very consistent that they don't see that as being enough. So I don't think there's a lot of risk that they adjust policy. Obviously, if they do, it's going to be a December situation all over again. Nobody expected them to move or adjust policy back in December, and they did, and it was a massive move. And I've heard a couple of comments coming out saying that maybe they released the sources piece because they don't want the markets, reacting or overreacting, or basically reacting before they make the decision. But just think about what that would mean for credibility. If you come out the week before and say you're not going to do anything, you release a sources piece saying you're not going to do anything. If you then adjust policy, what will that do to their credibility at this stage? It seems too much of a risk for them to go against that. But obviously, if you look at the reaction we had back in December, if they do surprise the markets based on just the massive amount of short positioning still sitting in the futures space, you could probably see dollar yen back down towards 130, I don't know, maybe 132, 134 in a hurry if that happens. But again, I think it's unlikely it does. The other thing to keep in mind is, we have seen quite a big move, especially today, in the 1 month and the 1 week risk reversals. And I have seen a few, analysts pointing out that maybe that means players are positioning for a surprise. I don't think that's the case. Remember that the markets got burned massively in December by that surprise. I think this is just hedging. I think this is the market saying, you know what, I'm just going to hedge myself in the event that we do see something massive happening, but I won't take this move we're seeing in the options market now as a directional play on where the markets really think this is going. I think this is just, buying some insurance going into the event.
So people can have a lion like your good self. Mr. Matthews, I can see our point scoring is working now. I bet you're wishing you never told us that it wasn't, given the state of the scoreboard. Looking at the BoJ, as Arno said, we came into the year after that surprise in December. Everyone was going, they're going to tweak yield curve control a little bit more, then they're going to do the inflation adjustment, then they're probably going to hike rates. We're sat here in, the end of July, the 26th of July, and it feels like we're having almost the exact same conversation that we were having at the start of the year. So, I mean, are we going to be sat here in another 6 months having an identical chat once more? And I guess the bigger question is, what is the bigger driver of the yen? Is it what the BoJ do, or is it, as Ewan rightly said and alluded to, where treasuries are going?
I think Ewan's actually correct. It's where treasuries are going. I mean, the Bank of Japan's got problems which the rest of the central banks, or most of the central banks around the world, are crying out for, aren't they? They're pleased that inflation's at a 41-year high. Is that right? Sounds familiar. And above inflation in the States for the first time for nearly a decade, I read. I mean, they've been praying for this for 30-odd years. I've got a funny feeling, actually, that they may do something on Friday, but what they do is literally just be a little bit of tinkering around the edges, I think, and I don't see it really upsetting the apple cart too much. I guess you're going to get more inflation pushes as they try to get the economy really roaring. I saw that Japan's largest trade union, that they're looking for large pay increases, the biggest ones for 30 years. But it's just it's a really, really difficult economy. It's a dead economy. Dead economy is a bit harsh, but it's a really hard economy to read. They're so insular. In a way, it's quite similar to China. I know that I always say you can't believe any figure that comes out of China. And Japan, it's so well telegraphed what they're doing and what the figures are going to be. It's a really, to me, an uninteresting currency. The only thing I would say, and I know Ryan's not here and he always accuses me of being a warmonger, what happens if a little rocket from North Korea shoves a rocket into Japan? And what does the yen do then? And don't discount it. Mark my words, do not discount that. But, I find the BoJ and the yen very boring. Being honest.
I think it is an interesting point you make, though, on the Japanese economy, because not only is it hard to read, and we'll get onto this in a second, I'm sure, but it's also very much kind of desynchronized from what you're seeing in other economies. As you said, inflation's still heading higher as it, touch wood, seems to have peaked pretty much everywhere else. Growth is okay-ish as it rolls over everywhere else. So I think that's an interesting theme for a very uninteresting part of the world and currency. Anyway, before we run the risk of...
interesting part of the world, it's just a very uninteresting economy and currency.
Part of the world economically, let me clarify. Before we run the risk of being taken off the airwaves in Japan, let's move on to the third round. Right, Arno, we may as well crack on with you here, given that you were desperate to, if I can get my words out, to talk about Eurozone economic data earlier on. What do you make of the data that we've had this week? The PMI, the IFO surveys, the bank lending survey. Obviously we had that upgrade to Q1 GDP last week that seemed to come out of the blue, and all of a sudden the Eurozone didn't have a winter recession. I mean, how close is the Eurozone actually to getting into a recession at this point?
So I think we are very, very close to it. The thing is, whether we get a recession or not, I'm not sure whether that's really what the market's attention will be on. Obviously, there's going to be a lot of media speculation about whether it's a recession or not. But from a tradability perspective, by the time that we do get a official recession, the growth story at that stage would already be fully priced in, so that's something worth keeping in mind. If you take a look at something like the City Economic Surprise Index, even though not a level of growth, a level of whether you are surprising to the up or to the downside, we've actually been seeing that putting in a little bit of a bottom recently. So that suggests that, maybe the markets are moving towards an area where we're reaching a peak pessimism, if you will. And I think even though I'm bearish the euro right now, I do think that we shouldn't ignore what's happening in China. Even though with all the made up data, what we're seeing there from the Chinese, I think China is an interesting one that could potentially offer some upside for the Eurozone economy a little bit later this year, especially if we start seeing some actual recovery in the economy. I think the market reaction to the Politburo meeting was quite interesting. If you read through the comments, and I mean, I can be wrong, but there wasn't really anything substantial in them from what I could see to really, change the view that drastically. But the market's reaction was massive. I mean, the A50 jolted up over 5% in just, 2 short sessions. So I think if we start seeing, if the made-up data we get from China starts looking better, if we can see that soft data start improving, and if we can see some actual real stimulus coming out, not just them saying they will sort out local government debt and just saying they will, increase local demand. It's easy to say all of those things and say all the right things, but if they bring out measures that actually tries to fix the property sector and tries to fix those things, I think that could be good for China. But from a trade perspective, I think that's actually something that could be a little bit of a saving grace for the Eurozone economy at a point where, I think the danger here is that we get so pessimistic just as we might start seeing things improve a little bit, so we've reached that level of peak pessimism. Everything is going bad. By the time that we hit a possible, official recession, maybe China starts to recover, and maybe then that changes the outlook for the Eurozone slightly. So even though I think it's bearish where we are now, I do think there is some potential positives to consider, as a spillover effect from China into the Eurozone.
Yeah, it's an interesting one. I think it's also interesting the degree to which over the last 5 years or whatever, the Eurozone has almost become a proxy for what's going on in China. It is so exposed and dependent to the Chinese economy at this point. It's quite remarkable. Ewan, I can see you've been scribbling away furiously there while Arno's been delivering that piece. I mean, is there any sort of economic bright spot out there at the moment, or is everything kind of heading in the same direction as the Eurozone, where manufacturing went first, services is now rolling over as well?
I've got to be honest. I mean, trying to read the macro picture at the moment it's seriously difficult. I mean, there's so many conflicting signals. So I mean, you just have to let price lead you at this stage. I'm not overly enamored with like what's coming out of China. I mean, what do we have, like these counter-cyclical measures, or taking away restrictions from the mortgage sector, and they're trying to push people to buy cars and electronics. I mean, how much stimuli can China do? I mean, it feels like every single year we need China to do something to push the market. And it's hard to see if there will be any powerful stimulus. I mean, especially from a state council level. We get the odd murmurings or anything like that, and then all of a sudden it's just liquidity measures for banks. I mean, if you do want to play it, then stimulus chat is obviously good for the commodity carries like the Aussie. And then we'll talk about the commodities themselves. I mean, you'd play copper itself, but I mean, I think we need a little bit of a reality check here. I mean, we've talked about like domestic demand in China and how they're trying to generate that, and that's how they're going to have to grow going forward. I mean, how can China grow at 5% when youth unemployment's at almost 50%? I don't know. I mean, that's the conversation that we should be having, right? And then we look at, all other measures. I mean, especially in the US. I mean, like the Conference Board's recession indicator suggests that there's a 99% probability that the US is already in a recession. So, we're by the time everybody starts talking about a recession, we'll already be out of it. The Reserve Bank of New York use the 10-year 3-month spread. I mean, if you chart that, that's the lowest since the 80s. And every time there's a dip in the chart, it's led to a recession. So we get all these conflicting views. And to be honest here, I think at the moment, if you are fully invested, it's cheap enough to get protection. But coming back to Arno's point there on especially the European Economic Surprise Index, it's quite interesting how there's been a divergence between that and the US. So I'm not sure how much impact that will have on the euro dollar trade, but it's certainly interesting to think that, you know, maybe expectations have bottomed out. Or sorry, bearish expectations have bottomed out in terms of economic situation in Europe and compared to the US. So that's definitely something that you should put on your radar as well.
Yes, definitely. It's an interesting theme, that, although I would just caveat that surprise indices are by their very nature mean reverting. So to answer your question, how do you get 5% GDP growth with 50% youth unemployment? It's very easy. One is the government.
You bring it up.
Well, yeah, exactly. The government delivers a load of stimulus and then you just make the number up anyway. And that's exactly what they've done for years, let's be honest. Mr. Matthews, can you provide any optimism, maybe even from home turf? You know, retail sales beat last week, inflation's coming lower. We may as well get the bunting out and pop the champagne, mightn't we?
Yeah, and the sun's shining outside for looking at it for half an hour. So actually, before I get on to that, I just want to pick up on something that Ioan said. The yield curve inversion is at its deepest 2 years before a recession, and a recession only starts coming when it starts reversing. So by that, we're 2 years away from a recession. Interesting, boring fact, but it's something.
No, I don't think it is boring. I think that's a really interesting point. And actually,
but he got that from the tulip mania.
Points off for that. It was in the South Sea bubble that we first yield curve inversion. I want a point deducted for that. That's just not fair. I've totally lost my thread now. Where we go? You were agreeing with me, Michael.
I was. What I was going to say was actually it is an interesting point, and what's more interesting is that if you look at, you know, the financial media or whatever, all of the alarm bells and the markets in turmoil and the red flashing lights are when the curve inverts. When it starts to re-steepen again, it's just 2s 10s is, you know, 10 bips higher, 20 bips higher on the week, whatever. There's not much fanfare about it. And, you know, going back to your analogy, I think there should be more.
Yeah, I mean, it does. It's interesting looking at it. That actually does front run it. Well, not that I should mention front running at all.
We're back to Spurs owner now.
They'll be talking about Tottenham next. So, you know, out of Charlie, we want to see them fib less and actually do something. Or as they say in Chicago, we will get off the pot. Whether they do, who knows? I suspect they might do. Helps Europe. Obviously, people look at Europe. The only thing they've got is Louis Vuitton, LVMH helps their shares, along with the Guard helping their shares. So, yeah, let's all pray that China does something to keep everyone on the beach in the south of France this year. I am very wary of PMIs. I think that if you ask, depends how you phrase the question, when you ask the question, if you're asking someone in the UK, or do you intend to buy more, and they're just announcing mortgage moves, you mentally are just going to be negative. So I think that they're a real dangerous set of numbers to look at. I think generally data is so skewed at the moment, and I've said this time and time again, and probably every time I've been on this show, none of us, and not even myself, have been to a point where we've had a pandemic followed by a war. I think the data is so screwed. The whole economy is changing. Employment's changing. People are working from home. They're not going to out to work. They're not buying things when they go out to work. You know, I don't buy suits anymore. You know, Michael's probably the last person left in London who wears a suit. Look at the suit. I've got my swimsuit on underneath. But I think everything is so skewed by this change in the economy, and I think it's really, really dangerous to look at figures. You know, look at US consumer confidence. It's ridiculously high. It's something like 117, which is miles over what you'd expect it to be. You've had 5 500 basis points or 5% moves in interest rates very, very quickly, and yet people are still happy and they're still out buying things. So I think it's a really strange economy, and all I can put it down to is the pandemic and how people just don't know how to react. And I think it's really, really hard to try and read into figures anything that's going on, and that's it's an awful answer for anyone listening. Ignore the figures, But I'm very, very wary of them.
But it's to go back to like what Mike really hates is people working from home. I think it's just look, great in his teeth. But that's it. But that's a structural shift in the economy, right? So I mean, people are not spending so much on, like you say, suits or commuting or anything like that. So they've got more money to spend on other things. So there is that structural shift in an economy that as yet we haven't learned how to read properly.
Yeah, absolutely.
What shares do you buy? You'd sell in London, you'd sell Pret, and you'd buy Tesco because you go to your local supermarket as opposed to a takeaway. And it's really, really hard. Yeah. I think this will take several years to come through, by which time it will be too late to actually interpret the figures. But I think it's a really important thing, and people put much too much onus on 1 month's figures.
Yeah.
Yeah. No, I think you're right. And of course, the broader implication of that is you've got policymakers and traders by extension who are trying to trade effectively by just feeling around in the dark, because, you can't trust the data that's coming in because it is so skewed. And of course, the other point is that survey response rates have fallen quite significantly. I think Ewan's raised that point before. So actually, not only do you have an economy that's still adjusting post-COVID and post-war, but also surveys that are using an ever smaller sample size than they have been, which skews things further. Just lastly, your point in terms of, adjustment and people shopping online and all the rest of it. If anyone from the delivery firm Every is watching, answer my bloody phone calls. You're useless. Right, let's get on to the last round. Awful company. If they're listed, short the hell out of them. Not investment advice. Right. It is the last show before the summer, which is probably just as well because it's going to descend into absolute chaos otherwise. So I want to just look ahead really to August and the start of September. We'll be back the first Wednesday of September, I'm sure. But really, what do we think is going to happen over the summer? Is it all going to be quiet summer markets, or is something a little bit spicier going to happen? Dick, we'll start with you because I assume that you're going to use the summer markets vibe as another opportunity to plug your favourite bottle of rosé.
Well, I suspect that several bottles of Minute will be being sups in the beaches of the south of France at the moment. Although a very good friend of mine was on the phone yesterday moaning about how hot it was down there. 38 degrees, which is much warmer than normal, but not terribly hot. I suspect we're going to have very thin markets, a little bit of volatility maybe because they're thin. People will be heading off. I suspect they'll head off at the end of this week before the Bank of England embarrasses itself yet again. And they go off and spend their 25 million quid's worth of bonuses. I can't believe they announced that they've done that. And I can't believe they've actually earned that much. I think that we'll get a quiet summer, but I think the problems are building up in the background, Mr. Doom and Gloom. I'm going to mention my favourite subject, agriculture. I'm going to get photosynthesis in for the second week. Hopefully score a bonus point.
There you go.
I'm not going to explain what it is.
Can you spell it?
No. But the smoke stops it working properly. But all joking aside, I talked about last week the problems in the agricultural markets, and actually it's really interesting watching what's going on in CBOT in Chicago. And those boys really do know how to trade. And anyone who wants to trade a lively market, you go and trade soya beans. It's one hell of a market. But all of the prices there, corn, wheat, they're all bouncing. You've got bombs getting grain out of Ukraine, and that's only going to get worse. It was interesting what you said earlier, Michael. The war isn't over. The war, I think, is going to accelerate. it's not done and dusted. I think Putin's going to come in and squeeze. Coming out to winter, he's going to squeeze energy again. You're going to have shortages of grain. India stopped exporting rice. Can you believe that? The world's largest exporter of rice has stopped exporting rice. That must affect inflation. I don't think people are looking at that nearly closely enough. I'm going back on my other favourite subject, trampoline inflation, that you're going to see it drop, level off, and bounce. So I think we will have a quiet summer, and then I think all hell will break loose September, October. Being an old man, going back to 1987 and remembering stock market crashes in 1987, I think you can see people come back from their holidays and suddenly go, God, inflation hasn't gone away, it's bouncing back. We've got problems still in Ukraine. Whoever thinks it's a good idea to lob drones towards Moscow, I think needs their brains testing. I just can't see a happy ending to that war, tragically. And if I had one tip for the summer, is put on lots of suntan lotion and don't get sunburned. Sit back, enjoy it, because it's going to be a tough winter.
Well, there we go. Thank you, Mr. Matthew, for your trademark cheeriness. I thought I was the grumpy one on this panel. Bloody hell.
I'm really hungry. I don't eat till 11 o'clock, so I'm really, really hungry. That's why. You've got 11 minutes. Hurry up, boys.
Well, I was going to say, all that stands between Dick and his breakfast is Ewan and Arno's answers to this question. Ewan, can you offer us any more optimism than that in terms of what might happen over the next 6 weeks or so?
I'm surprised Baz Luhrmann didn't talk about orange juice futures, eh?
Yeah, OJ. Well, it's not time for frosts yet. That's really, OJ becomes really, really interesting at the end of the year when you get frosts in Florida, or you get rumours of frosts in Florida, from my memory.
Well, the crops are like 86-year low or something, isn't it?
Yeah.
With orange juice futures record high.
It's a really juicy trade, that, just trying to squeeze everything they can out of it from now on.
All joking aside, they really are, valid markets, and they're good markets. Really, excuse the pun, good liquidity in them, and they should be looked at. And I know I said this last week, and everyone was laughing at me. I think it's mad to ignore them.
I think we're going to have to call you Louis Winthorpe III.
Thank you.
But yeah, I mean, I think what was interesting with the latest Bank of America Fund Managers Survey, I mean, they're the most underweight commodity since oil was negative. I think what was also interesting is that they're the most overweight in cash and the least overweight in equities. So, I mean, if you're looking for some sort of positivity or something, then I know there's some conjecture about whether we're in a bull market or anything like that. So I saw an interest in, I think it was briefing.com, had the average length of a bull market. So it is just over 1,000 days. And since the 30s, I think the average bear market has lasted 286 days. So if we consider this to be a bear market, a bull market, sorry, then to get to the average in terms of gains and length, and from here the S&P would need to gain another 70%, and that would take us to July 2025. Now, I mean, that's interesting in and of itself. But I mean, we've talked about it before. Things like put call ratios are all time low. I think what was really interesting as well is that the equity risk premiums are a 20-year low as well. So I mean, that effectively could be a headwind for longer term returns anyway. But it may be too low. But so, I mean, if you look at that, the S&P dividend yield is 1.5%, and the 6-month T-bill yield is almost 5.5%. So, what do you do? I mean, especially over summer, I think, summer trading means scalping, right? So it's not the greatest period to hold on to trades. You got to get in and out, and on reduced position sizes as well. So, I've been looking at the volume, and I mean, the recent trend's been heavy volume on the open, and then it just tails off into the afternoon. So, I mean, for me personally, longer dated S&P puts I don't think they've ever been so cheap. So, I mean, you've just got to protect yourself against, some sort of major drawdown over the next 12 months or so, and keep an eye on orange juice futures, obviously.
Well, there you go. We've had Dick, protect yourself against the sun with your sun lotion. Ewan, protect yourself against downside with some puts. Arno, what are you protecting yourself against? Power outages, something like that?
Pretty much, yeah. I mean, if I can, as long as the solar units are running, everything will be fine.
Obviously the sun comes out.
Exactly. We've obviously got winter this side, so slightly different. But in terms of summer markets, I do think there is something brewing that could provide some spice for the markets. I know Richard has been saying this for months now, that he doesn't think inflation will be solved as quick as the markets think. And I do think in line with that the risks of a bounce in inflation is really growing here. And I think it's an underappreciated risk. I tweeted about this, I think 3 weeks ago, talking specifically about the housing market. We've seen such a massive bounce in the housing market, and that recovery has been seen as a very positive input for growth, input for the economy, and rightly so. But what I also think that has done, if you just take a look at very, very simple home price leading indicators, it's put quite a bouncy move or potential move in home prices and rental prices in the months ahead. And obviously, being such a big component of the CPI basket, I think that is an underappreciated risk for core inflation to not go down as fast as everybody anticipated to. Now, while that is happening, we've been talking about commodities, but we've seen massive moves across the board. I mean, oil is up over 12% since the end of June. Wheat is up over 15%. Corn is up over 10%. Gasoline prices up over 12%. That's something that's going to start impacting the consumer. We've got the Goldman Sachs Commodity Index, I think, up over 11% as well. So you've got the risk of higher rental and home prices. You've got, from the short-term perspective, higher commodity prices. And all this is happening while wage prices have been increasing as well. I mean, the recent, even though jobs numbers came in slightly below expectations, the wage number was very hot in the US. So you've got hotter wages, risk of higher home and rental prices, and now commodity prices are up. So I think, if you're looking for something to spice up, during the summer and directly after the summer, I definitely think that inflation making some form of a comeback, even if it's a short-term one, is a real risk for the markets. We've also started to see 5-year and 10-year inflation break-even rates starting to push higher as well. So I think that is something that could really spark a little bit of rate repricing, because the markets have almost gotten, comfortable with the idea over the past, let's just call it 2 or 3 months, that the Fed will win the fight, that inflation will be going down. We've seen headline where we are at 3.1%. Now, everybody's celebrating right now with core at 4.8. But what if we go down to 4.5, maybe 4.3, and then we start going up again? That's something that I do not think this market is priced for at all right now. Everybody's been piling into long bonds. Everybody's been piling into to long equities. I think the risk is that if rates needs to reprice because inflation isn't going down, then commodities will probably be a good hedge to start considering in that environment. And, like the guy said, protect yourself against risk for equity downside, protect yourself against the risk that maybe yields have one more leg to run to the upside. So I think if anything is going to spice up the summertime, it's going to be inflation that makes a little bit of a comeback.
What a brilliant answer, and what a great note on which to end the show and look at the final scores. Well, against all odds, Mr. Matthews says, put your glasses on, Dick. You're not last, miraculously. You're going to have to send another wooden spoon down to South Africa. Ewan, congratulations once more for winning the show. Well done, mate.
Thank you.
Good stuff.
Well, what a good summer.
Right. Well, that does bring us to the end of another show, and also to the end of this kind of run of Trading Blows. As I said, we're having a little bit of a break, and then we'll be back in the first week of September. Thank you very much, as always, to Dick Matthews, Arno Venter and Ioan Smith for joining me. Thank you also to Ryan Paisley and Adam Linton for coming on the show over the first 6 months of the year as well, and also to our producer, Kerry Akos, who brings this together so brilliantly every week. We all wish you a very good summer, and we'll speak to you in September. Thanks as always for watching, and goodbye for now.
Have a great summer.
Cheers, guys.